Thanks for joining us today on Know Your Options. I'm Morella Fernandez. We do the show every 2 weeks, and we take a look at the fundamentals of puts and calls and how you can use them effectively as an investing tool. So here's how to reach us with your questions today. 1-855-326-6266. If you would like to get a phone call in, you can email your questions as well. Know Your Options at bnnbloomberg.ca. Chris Tom joins us now, CEO, Portfolio Manager at Moat Financial, as we walk through some of the more difficult parts of investing. Chris, start by talking about, if you don't mind, what an option expires and actually what happens then.
Yeah, so remember that an option is actually a contract between two investors, right? So it's different from a stock. And with that, it has an expiry. So when the option gets to that expiry day, if it's in the money, it will exercise. And if it's out of the money, then it will just disappear. So to define those terms a bit, in the money, if it's a call option, it means the stock is trading higher than that strike price. And on a put option, it's just the flip side where the stock is below that strike. And it will automatically exercise. If it's 1 cent in the money, the market does its thing and makes that transaction on the stock.
Okay, so can you explain a little bit more for both the buyer side and the seller side what it means to them personally and how they sort of operate in that?
Yeah, so when somebody buys an option, they are buying the right to buy or sell that stock for that strike price by that expiry date. So they have all the rights, and for that, they gave up some money. They gave up some premium. The other side is giving up those rights. So you're saying, okay, look, if the stock goes above this number by expiry, I'll sell you my stock. And if it goes below, then you can sell it to me. So one thing that's actually really important to remember here, because of this auto exercise, sometimes people can forget the liability that they are creating even when they are on the buy side. So if you buy, say a stock's trading at $90 and you buy a $100 call and the stock goes to 110, it's well in the money, expiry comes, it's going to exercise automatically. So you now are going to be buying that stock at $100. So let's say you did one contract. Each contract is 100 shares, so at $100. You need to have $10,000 in that account, or else you're going to be put in a big debit. On the flip side with the puts, you buy that put, you've got the right to sell it, the stock goes down, you're happy, you've made this great trade. But if you don't sell that or have that stock in your account,
ready and available, yes,
then you're going to be short that stock. So if you do this in a registered account, if you're buying these options in a registered account, you could actually be setting yourself up to be offside if you don't deal with it early and make sure you've got everything, all your ducks in a row.
Is there a penalty for that?
I guess it would probably depend on the institution. You're definitely not allowed to be short stock in a registered account. So you'd need to be getting that remedied pretty quickly. But yeah, you shouldn't be shorting stocks and you shouldn't be running a big debit.
Okay, so what happens if I change my mind, right? I make a decision February 1st, I put some options in place, and it's a 30-day strike. And then I say, mid-month, I change my mind. What are my options?
Yeah, so you've sold that. You've sold away your rights on this. But the beauty is these options trade in the market. So if you change your mind, you can do a few things. First one is just buy it back. You sell a put. You say, I'll buy this stock at this level. If it goes down, stock starts going down. You say, actually, I changed my mind. You buy it back. Your obligation is gone. Maybe you're buying it for more than you sold it for, maybe for less. It's all going to depend on what's happened with that stock.
Okay.
The other thing you can do is rolling it. So this is what we do a lot in our ETF. This is what we're talking about on the show. You sell that put. It's in the money. You say, hey, I don't want to take delivery of this stock right now. You buy back the option and you sell the same strike but out further in the future. So you're really just kicking the can down the road. You're just replacing one position with something similar that has more time in it. But when you do that, you're collecting more premium. You're generating a credit, and you're just adding more income to your overall portfolio. And now your obligation to do something in 30 days is gone, and maybe now it's 60 or 90 or wherever you've set it.
What's the longest period you can put something in play?
So the longest options in Canada go out, I think, to December 2028.
Oh, wow.
So there's some on that they've got these leaps that go out really far. And then, yeah, I mean, we talked, I think, last show or the show before about some of these options on the S&P 500 that expire every single day, or on the Mag 7 that are expiring Monday, Wednesday, Friday. So you definitely see a lot more volume on the shorter dated stuff.
I was going to say, what's typical, or is there a typical?
Yeah, I think what you'll see, people who want to make sort of long-term, longer bets, if you want to call it that, on stocks, will go for the longer dated options because they decay slower. But the shorter dated ones, I mean, you can use options to eliminate risk, or you can take a whole ton of risk with it. And so I think the shorter dated stuff, people might be using them a bit more as a casino.
Yeah.
But
Okay.
yeah.
So if you change your mind, which is something we just talked about, how often do you do that at your level? You mentioned instead of sort of just changing your mind, you'll kick it down the road, which makes sense. How often would you say you do something like that?
Yeah, we roll often. Okay, so we do it on the call side. Something goes up more than you wanted it to. You can maybe buy that option back and sell a higher strike call. So you're rolling it up and out.
Okay.
And then on the put side, same thing. I mean, unless something fundamentally changes with our view of that stock, we will typically roll that option rather than take delivery. But sometimes it just makes more sense to take delivery. You can collect the dividend, or you can start to sell a call. So it really is taking a look at each situation and deciding where the math makes the most sense.
I was going to say, if you're just starting out and you're an investor who wants to get involved in options, what's the most basic piece of advice you would give to them?
So obviously, do your research, take a look at, as much stuff as you can, watch as many webinars as you can to make sure you fully understand it before you do it. Have somebody you can talk to, whether it's an investment advisor or just somebody with experience. We're actually doing a webinar in 2 weeks with the Montreal Exchange, talking exactly about this, the option expiry and what to do with expiring options. So there's a lot of resources out there.
Okay, so there's lots of ways to get started. Okay, let's take a quick break. We'll line up the first phone calls and emails for Chris. The number to call us at 1-855-326-6266. You can email your questions as well. So that is knowyouroptions@bnnbloomberg.ca. We're back in a moment. Stay tuned. All right, time now to take your phone calls and your emails here on Know Your Options. We'll start with an email from Andrew. He says, hello, if the put is below the strike price and the fund is then forced to buy a stock, where's the stock held? So inside the fund, or is it owned by a separate entity that provided the capital to buy that stock? And how are any dividends from that stock handled? So a couple of different questions within the email, but interesting on how things work. If you're forced to buy, what happens?
Yeah, so if you've sold that put, stock's gone below, and you don't adjust it, roll it out, or buy it back, then yeah, you get put the stock, and it'll be in that account. So if you do this in your individual account, then that's where the stock ends up. And if it's in a fund, then that's where the stock ends up. And then once you own the stock, it's just like you bought it on the open market. You own it. If there's a dividend and you own it over that ex-dividend date, then you collect those. And it's really no different. It's really just a way for you to buy that stock at a lower price and get paid in case it doesn't go down.
So it doesn't get treated any differently?
No.
Got it. Okay, let's get to another email then. Teresa has written in. She says, I've owned ABUS since the time of COVID. I was thinking of writing an April covered call at a $5 strike price. All these years, it hasn't really done anything. I'm not losing on it. But my thought is, why not earn a bit of money before I let it go? Could I have your thoughts on the stock and I guess the strategy around it? What do you think?
Yeah, so it's obviously a biopharma stock. It's not something that I know too much about, but just taking a look at the stock, it's trading around $4.68. The April $5 call is 25 cents. So you're going to collect, 5%, 5 and a bit percent, plus you've got that 32 cents of upside until you hit that strike. So I would say if you're comfortable selling this stock at that level, then do this all day. Looking at the price of the option itself, it shows as about a 50-cent wide spread. It shows as no bid to 50 cents. But you can see that it has been trading at 25 cents. So if that's where someone did want to trade it, I think you'd get a fill at or around 25 cents. And then you only have to wait, I think it's 37 days until expiry, and you're good to go.
You said no bid for 50 cents. How often does that update?
So it's live, right?
Okay.
If somebody comes in, obviously the market maker on this isn't super active. It can be a bit tricky on these lower dollar stocks to get that volume. And this is one where, again, I always end up being the great defender of Canadian options. This is an American option, and liquidity's not that great, but there is decent underlying liquidity. So if you put that offer out there to sell these at 25 cents, I think you'll get a fill, even though when you're looking at it, there's a 0-cent bid and a 50-cent offer. So it's a huge, wide spread, but there is activity underneath there.
Okay. Let's go to our first caller then. Jim's on the line. He's in Whitefish, Ontario. Hi, Jim. Jim, are you there? Okay. I think we may have lost Jim. Let's move on to our next caller. Ron is on the line. He's in Mississauga, Ontario. Hi, Ron.
Hi, how are you?
Good, thanks.
I've got a question. As an inexperienced option trader, is it a wise strategy to write a uncovered put to provide downside risk and also giving you the opportunity to utilize the premium you received in the meantime?
Okay. Thanks for the question.
Yeah. So, I would say yes, this is what we do all day, right? You mentioned uncovered. So I would hope that if you are selling this, you do have the cash to buy the stock. So that you would be covered in case it does go down. You're not left in the lurch saying, hey, I need to buy this stock for $10,000, but I only have $5,000 in cash. So make sure you do have that cash coverage. But absolutely, if you have a stock that you like and you would like to own, this is always the first step in deciding what options to sell. Has to be a stock you're comfortable with. And then if it lines up with some meaningful premium you can sell in order to make that commitment, then absolutely, this is what we're doing all day long.
Okay. Let's go on to our next caller then. Reg is on the line. He's in Winnipeg today. Hi, Reg.
Hi there. Thanks for taking my call. So I got a specific question here. So on Manulife, I phone in every once in a while just to give some oxygen to Manulife. Can you explain something to me here? So about 3 weeks ago, their earnings came out. They beat the analyst expectations handily. The reward for the stock is it went straight down. It's gone down about 12%. When you do a deep dive on this, you'll find that, for example, the last minute of the trading day on the TSX, this volume on this stock more than quadruples. And you look at who's doing the buying and the selling here, it's all the financials and their subsidiaries buying and selling the stock back and forth to each other. As little as one share. You see a lot of anonymous buyers and sellers, right? This makes no sense why this stock is $45.85. It seems like there's a bunch of gimmicks going on here. I don't understand why the regulators or the exchange doesn't look into this more, because it seems like the retail investors here, there's two different kind of platforms going on. Retail investors buy and hold aren't getting the straight shake, and it seems like the institutionals have either program trading going on or algorithm trading. It means nothing what Manulife makes as far as the profit. Thank you.
Thank you for the question. Is something like that easy to see when you're looking at the data available to you, and what's your take on the situation with Manulife?
There was a lot to unpack there,
yes.
But I thought there would be an option question coming at the end there, but
there wasn't.
Yeah, Manulife is not a stock that we own. In Canada, it's definitely the type of business that we do like. That there's pretty limited competition, and a pretty captive audience. So I haven't looked into why it went down. I guess I'm a believer in the financial markets that it's fair, and if some people were pushing the price down, then that would be creating opportunity for others. So I would say I don't have a rebuttal to all that, and
not really any insight per se. Okay, Let's go to an email then from Jackie. She says, I sold a TRP March 20th, $82 call option, so for $3. Do you think my option will be called on March 20th? That's a hard one to answer, isn't it?
No, well, this actually ties in with what we were talking about, where that stock is about $86, and she sold a 82 call. So if she does nothing on the 20th, that stock will get called away.
Okay.
So as of right now, the stock, she sold the option for $3. It would now be worth about $4 and a bit. So could buy it back and now it won't get called away, or could roll it out. That's probably what I would do. You just kind of kick the can down the road and collect a bit of a premium. And so to move that out to, say, May, you could pick up about $1, which on an $4 stock or whatever it is not bad just for keeping the same commitment you have already made in the past.
Okay, so kick it down the road for another month or so. Let's get to the next email, which is from Michael. Michael is saying, I own Fortis, and I've also been selling puts on the stock for a while. The premiums I've been collecting are not a lot, but I'm happy. What are your thoughts on selling puts on utility stocks? Also, can you please recommend a good covered call selling ETF? So let's talk about puts, first of all, on utilities. What are your thoughts on that?
Yeah, so utilities typically have lower volatility, and the options are typically not that expensive, but that doesn't mean you can't sell them, right? It's all about just picking a level that you're comfortable owning the stock. So Fortis, as the example here, we had sold some in our ETF. The stock has rallied, and now we've kind of backed off. We'll wait for it to go a little bit lower and get more towards the bottom of its trading range. But Fortis, I mean, they've raised their dividend like 56 years in a row or something, and we'd expect that to continue. So it's not going to move around as much. So it's something that you can sell puts typically a bit closer to where the stock is trading because you just don't see as many big, huge swings.
I was going to say they're more range bound.
Yeah. So, but at this level, we've backed off, and we'll wait for it to drop a little bit, and then we'll get back in there. And as far as the
ETF,
yeah, the ETF goes, I mean, these are the covered call ETFs are the fastest growing area of the ETF space in Canada. So it depends what you want. There's, single stock covered call ETFs. There's ones that sell calls every single day. There's some that have specific sectors. So you really need to dissect kind of what it is that you're trying to get from it. Are you trying to have one that generates as much premium as possible and limits the upside? Or do you want one that leaves more upside and just generates a bit of premium? So it really is kind of check what's out there and then find the one that meets your needs.
Why do you think they're so popular now?
It's the income, right? If you are adding a covered call to an existing position, you're not adding downside risk, and yet you're adding income. So we have a country that is hungry for yield at all times, and here's a way you can add yield without adding risk. Now, I will say on the covered call side, it does kind of miss a bit in that they don't sell puts. The puts, if you're a bit more worried about the market, then you can have that and add in some downside protection where you're less reliant on the market staying flat or going up.
Got it. Okay, let's take a quick break. We will come back with Chris's top options trading ideas. Back in a moment. Time now to have a look at top options pick ideas from Chris Tom. We're going to start with pet value. I want to ask you why pet value before you lay your own strategy.
Yeah, so pet value is, they've got all the top retail pet store brands in Canada. They've got 823 stores. Pets. I'm not a huge pet guy. I'm kind of allergic to dogs and cats here, so okay. I think I'll probably get some calls from my friends after this one saying, look at you recommending a pet store. But people spend money on their pets, right? On an individual basis, the numbers continue to climb as to what they are spending it on. And people want that retail experience. This is something that, you can order dog food on Amazon, but a lot of people want to go to the store and see what else is there or get some fresh stuff and have a bit of a routine. And, we're still coming out of COVID where animals, people were getting pets and, those pets are still here. So it's something where they've got about 20% of the market share in Canada for pet goods, and they're just continually opening more and more stores. And the part of the thing that pushed the stock down in the last little while was their earnings, which were good, but their same store sales weren't really rising. They didn't have a really robust forecast. But for something that's trading around 16 times earnings, personally, I don't really care if they grow that much. They're making money, and you can buy the stock pretty cheap.
Okay, so what are you going to do with a stock like Pet Value?
Yeah, so here we are. The stock's about 23 and a quarter. We're looking out to April and selling the 22.5 put, and you can get about 45 or 50 cents for these. So you're going to get 2% for just over a month, and you're making a commitment to buy this stock at a 52-week low. And what's interesting with this one is this is only about a $1.6 billion market cap company. And the options on this, if you look at it, they look like, there might not be there's a bit of a wide spread. This is one that people would take a look at and say, hey, I'm not going to sell those or buy those because they're illiquid. But the liquidity is actually much more robust. And if a person is just putting in their offers, slightly below that midpoint, we've been able to transact when we've sold these. Disclosure, we sold the 23.5s in our fund. Now the stock's come down a little bit. So we're saying, hey, if you want to generate some premium, 2% for a month and a half, look at these 22.5s. And your worst case scenario is you're buying the stock at what will be net about 15 times earnings. And that's a good value. Okay.
Let's get to your next pick, TMX Group. What is your strategy for this one? And this is a company that kind of stands alone, right, with what it does.
Yeah, for sure. I mean, a theme that we often have is that we like these monopolistic or oligopolistic, I don't know, is that the word?
Sure.
For companies that just have limited competition, have big moats around them. And, a lot of the industries that they're in, they are the only player or the biggest player in a small number of competitors. So, the stock got beaten up because everyone thinks that AI is going to take over and, banks are going to lay off half their employees.
So that same sort of software scare.
Yeah, less terminals and all that. But quite frankly, because they have a monopoly on a lot of this data in Canada, the chances are that, in our view, that the stock is cheap enough and that they'd be able to offset any of these losses by price increases. And really, it would be theft, be stealing it if you were using AI to replicate what they're doing. So here we are. This is a repeat trade. I did this a month or two ago. We sold the March 44 put. So now the stock's moved up a little bit. We're going to move it up to the 45 put out to May and collect about 90 cents. So 2% for 2 months for a stock that we think is towards the bottom end of its range. If it goes down, we'll buy it. If it doesn't, we make another 1% a month, and we're happy with that.
Got it. Okay, let's get to your last pick, which is Suncor. And I'm wondering whether the events of the last 10 days is affecting your outlook or your thoughts on plays in energy.
So Suncor, if you go back to 2008, when oil went to $150, it went, way higher. And then oil settled down. And obviously, we had a financial crisis, so that didn't help. But the stock went down a lot from there. So the stock, if it gets to $84, this will be a 17-year high on the stock, and we're comfortable selling it at that level. It's getting up into the high teens, which is still decent value for an energy name. I like them that they're fully integrated. They've got everything from exploration all the way to pumping gas into your car. But this is a way to bring in about $1.15 for making this commitment to sell the stock, about 6% higher. That $1.15, that's about half a year's worth of dividends. So if you own this for yield, you're going to amp up that yield in a big way. And, your worst case scenario compared to just being long is that you have to sell it at a 17-year high.
Okay, so did you decide on Suncor during this period, or was this something you were going with before?
Yeah, so anyone who's watched the show for a while has seen when it's in the 50s, we're selling puts. We're saying, hey, we're willing to buy this in the low to mid 50s, and we want to get paid for that. Now that it's moved up into the high 70s, now we go to the other side and say, hey, if we own the stock, let's generate some premium by selling some calls. So Suncor is the one that we feel like it will go up less if oil really spikes because of that integrated nature.
Okay.
And so we'll set this, get some additional premium, and if it goes up, we'll sell it. And having a diversified portfolio, we've got other oil names that will participate as well.
Got it. Chris, got to leave it there. We're out of time. Thanks for your time. That wraps up Know Your Options. Chris Tom back in 2 weeks' time, March 25th. See you soon.